The barrel between $90 and $100, an alarm bell, dotting I's and crossing T's with Nasser Kandil. No sooner had the US President Donald Trump announced that oil was flowing through the Strait of Hormuz and spoken in a defiant tone about the future of negotiations with Iran, then the price of a barrel of Brent crude exceeded the $90 threshold. This is not merely a passing movement in a highly volatile market. A return to the price record since the start of the US-Israeli war on Iran on the 28th of February reveals that the distance between $90 and $100 was short in every previous wave of escalation, and that reaching $100 marked a transition from fears over supplies to fears over the economy, before those fears turned into political pressure on the White House to halt the escalation or to open the door to negotiations. The first wave began after the war caused widespread paralysis in the Strait of Hormuz. Brent closed at $85.41 on the 5th of March amid an almost complete halt in shipping, disruption to Gulf exports, and Iraq and Qatar being forced to cut production because their storage tanks were full. The following day, the barrel jumped to $92.69. It took only one trading session to move from the 85 to 88 range to break through $90. During the next trading session after the weekend, the price exceeded $100, reaching a peak of nearly $119.50 before Trump's signals of a possible move toward negotiations triggered a sharp fall. The market then returned to stabilize the price above $100, with Brent closing at $103.14 on the 13th of March, before rising to $112.57 on the 27th of March. The same scene was repeated in July more clearly. On the 20th of July, Brent closed at $89.22, coinciding with Yemen's announcement of a ban on shipping linked to Saudi Arabia and rising risks in the Bab el-Mandab, while traffic through Hormuz remained extremely low. On the 21st of July, the price exceeded $90 and closed at $91.01, and then reached $94.07 the following day, before jumping to $100.69 on the 23rd of July. The market needed only 2 days to move from $90 to $100. The jump came as Saudi tankers were attacked, oil export routes through the Red Sea were threatened, and US-Iranian strikes were exchanged. It was here that share prices began to reflect a transition of the oil crisis from the energy market to the economy as a whole. On the 13th of March, when Brent closed above $103, the Dow Jones fell 0.25%, the S&P 0.6%, and the Nasdaq 0.9%. On the 23rd of July, when the barrel reached $100.69, the Dow lost 1%, the S&P 1.2%, and the Nasdaq 2.2%. Tesla shares fell 14% and Alphabet 7%, although news of massive spending on artificial intelligence also contributed, alongside oil, to the pressure on technology shares. Shares are not affected in the same way. Energy companies benefit from higher crude prices, while airlines, transport, industrial and retail companies are hit. The Nasdaq is more sensitive because rising oil prices increase inflation expectation, push bond yields higher, and delay interest rates cuts. After oil remained above $100 in March, airlines began cutting flights and raising their fuel cost estimates, turning movements in the price of the barrel into lower profits, higher prices, and weaker consumption. As for the current wave, it began with Brent closing at $88.52 on Friday, 14th of August, on the eve of the expiry of the 60-day deadline contained in the US-Iranian Memorandum of Understanding. During the weekend, only 5 vessels crossed on Sunday, while tracking companies recorded no vessels crossing on Sunday, compared with around 130 to 140 vessels per day before the war. When markets opened on Monday, the 17th of August, Brent exceeded $90 and closed at $90.87. This occurred as the deadline expired without an agreement. Iran announced that it would move from a defensive posture to an offensive posture if mediation failed, A UAE tanker was detained, and Aramco was forced to offer cargoes to Asian customers from outside Hormuz via Fujairah, Yanbu, and Sidi Karir. This is where the political impact begins. Experience shows that $90 is an economic warning threshold, while $100 represents a threshold for political intervention. At $90, Washington begins looking into oil exemptions, drawing from reserves, intervening in the future markets, pressuring producers, and intensifying mediation efforts. At $100, the cost of the war becomes a domestic issue linked to petrol, inflation, interest rates, shares, and elections. When oil exceeds $100 in March, exemptions were expanded, the release of reserves began, and political and military deadlines followed one after the other. When Trump announced a 2-week ceasefire on the 7th of April, Brent collapsed by 13.29% in a single session to $94.75. In July, after the barrel closed above 100, Trump suspended the strikes to allow another opportunity for diplomacy, causing Brent to fall by 8.7% on the 27th of July to $88.36. Brent is now only around 10% away from $100. This is a distance the market covered in July in 2 days, and in March in a single trading session after the weekend. Therefore, breaking through $90 does not mean that reaching $100 has become inevitable, but it does ring the alarm bell. The time available for diplomacy is narrowing, and the market has begun voting against the continuation of the war.